Hi, my name is George Dagnino. I'm the publisher of the Peter Dack Portfolio Strategy and Management. I worked for large corporations. I was hedging billions of dollars of interest rates derivatives, and my job really was to think out of the box, as people who work with me used to say. And and this is what this presentation is about: is thinking out of the box. So stay with me. And what triggered this video is that I read, bond yields declining on Fed rate cuts. I I don't know where they think what they think about when they write that stuff. As I said, I come from a large corporations. I know large corporations work and how top management thinks. They have big budgets. The third quarter usually multi hundreds of millions of dollars. They have to finances. That what the treasurer does. It goes around to the two or three major big banks, four big banks in the United States and overseas, and try to connect all the financing in the various countries where they have to deploy capital. Now this is big money. This big money, when you have that kind of demand, that has an impact on interest rates. And this is where I'm coming from. The Fed has little to do with that process. The Fed only controls that, at least they would like to control the viability of the banking system. Last March, obviously, they could not with the SVB and the other California banks. But my point is that is business where they have to expand and increase production. They have to increase capital. They need capital. They need people. They need raw materials. They really need money. And this is huge, huge trillions and trillions of dollars that business needs, hundreds of thousands of people that they need. So this is the forces that are driving the markets. It's not the Fed. It's not the Fed. So the fact that bond yields are declining is not because the Fed is lowering interest rates. It's because the economy, business is now retrenching, has finally brought inventories under control. They see demand coming down, and as you can see, the ISM and the PMI surveys, they show that manufacturing is in recession and business is really playing big time defense. This is what takes down interest rates. This is what takes down commodities. This is what takes down inflation. And this is what the main causes of the business cycles. So what I'd like to do in the next graphs is to show you some evidence of what is happening and is probably what is going to happen. And again, when people talk Fed, I turn off the TV or the radio or anything because it doesn't matter. The Fed follows the markets. It's trying to adapt to the markets so that they do not create distortions. That's about it. That's about it. Okay, this is what I was talking about the banks. The banks are not extending credit, okay, which is the dark line, and they're not lending money. Why? Because they see trouble. They don't see a healthy business environment. So when you don't extend credit, it's because business is really not doing well. And this is the reason why the money supply is also, by the way, the loans that the banks are making is what really is creating money, are the banks that are printing money. So by not lending, there is no loans activity around the banking system. There is lower lending activity, and therefore the money supply is contracting. The Fed doesn't have anything to do with this. It's just the banks, business are doing well, loans are not going, the money supply slows down. This is it. The Fed is just an observer. And this is what is happening in the real world. The banks, I showed you, they don't lend, they don't extend credit, they do not lend money. And this is what happens to the money supply. The money supply is contracting. So the money is contracting is why? Because business is doing very, very poorly. So how bad is business doing? Well, if you look at industrial production, as shown also by the Purchasing Managers Index, both the ISM and the PMI, and this is the Industrial Production Index, which is the red line, has been going down because business is not producing, manufacturing is in a recession. Now, the blue line is retail sales after inflation, and as you can see, they're going down year over year is contraction. So that's why banks are not lending. That's why interest rates are declining. That's why commodities are weak. Because that's why employment is slowing down, because business is not doing well. And this chart shows inflation expectations. And as you can see here, they're coming down quite sharply. Why? Because as I told you, business is not doing well, commodities are declining, the money supply is contracting. Now, about the money supply that I showed you in the previous slides. You know, when the money supply was growing at 0 to 5%, 6%, inflation was zero, between 0 and 2%. When inflation in the 70s, the money supply was growing above 7%, up to 12, 13%, and inflation went up to 20%, that was okay. Now, the money, okay, in 22, the money supply went skyrocketed and inflation went up to 9%. So everything is okay, the money supply works. But now that the money supply is contracting, they say this time is different. No, what the money supply is saying, the business is so bad and banks are tightening credit so hard that we are not going to have inflation as this chart is showing is going down. But most likely, prices are going to decline. In fact, if you look, as I showed in other videos, on my tweets and in my service, already prices of durable goods orders and housing, among other things, are already declining. So there is already deflation coming, is already in the working. It slowly is going to come to eventually at the consumer level, which is much slower coming. And this chart shows and proves my point. You know, when business was strong from 16 to 18, interest rates started moving way ahead of the Fed funds rate, which is the rate set by the Fed. Here, business in 2018 started slowing down here, and sure enough, interest rates, they didn't need money to build inventories, manufacture goods, demand was slowing down, and interest rates, short-term interest rates came down. The Fed recognized that and then adapted to the markets. Here is the same thing. The economy started strengthening because of the huge amount of money printed by the government, and interest rates started rising. And then after a year after, the Federal Reserve started raising rates, quote unquote, raising rates to the banks, not to the people. People already in the marketplace, interest rates were already rising for a year. Now, this is what's happening now. Interest rates have peaked. They peaked because business is slowing down. Inflation is coming down. There is already deflation in some sectors of the economy, so interest rates have peaked. The Fed pivot or no pivot, that's, to me, is absolutely, when people don't know what to talk about, they don't have enough knowledge of the business cycles and the forces of the business cycles, it's much easier to talk about the Fed. So they talk about things that maybe not, the Fed will do this, the Fed will do that, maybe Powell will longer forever, whatever it is. And they keep on chatting like old ladies, with all due respect to the ladies. But the fact is that the markets are driving what the prices, and that's the way it is. But people, the TV personalities, don't talk about business, what's going on in the business, what are business decision making thinking, and how the forces of the business cycle are going to drive prices. They prefer to talk about what the Fed will or will not do. The fact is, business is slowing down, inflation is slowing down, and prices of commodities and interest rates are coming down. Unless business that thinks that become optimistic again, but that's the story for another video. Okay, thank you. Just a reminder that if you want to see my work and what I said in the past and what my commentary is on the business cycles, you can have a free subscription on www.peterdack.com. No credit card required, so you can cancel anytime. It doesn't matter. I wrote this book. It was commissioned by McGraw-Hill Education and is available in Asia in many languages. I also wrote 2 more books, and I'm very active in the YouTube channel, by the way, where you find, of course, these videos, and also on Twitter. Well, thank you very much for reviewing this video. Please leave your comments and don't forget to subscribe to this channel. It helps my status with YouTube. Okay, thank you very much. I'll see you really soon. Take care.